Hi there. Uh, let's get started with this particular video. In this video, I'm going to cover something related to Fibonacci and that indicator can be used in the forex market. So what we are going to cover in this video is we are going to cover about the Fibonacci lines, how do they work in the forex market. We'll also look into a simple forex Fibonacci strategy which is simple and effective. And then finally, we are going to cover the important points to remember when using the Fibonacci in the forex currency pairs. So we'll try to keep this video short. Let's get started with the Fibonacci lines. In the Fibonacci lines, just to cover the fundamentals, which a lot of traders would like to know. There are two main kinds of Fibonacci lines. One is the retracement line, which is used when the forex currency pair is pulling back after a particular run. The other kind of Fibonacci line is the extensions, which are typically plotted when the currency pair resumes original direction after the pullback. But in all the cases, in both the retracement and the extension, the important levels are 38.2%, 50%, and 61.8%. So let's look at this particular figure here. If you look here, the currency pair started its upward movement, upward journey starting from here. Then it continued up till here, and then it had a pullback. When the pullback happens, using your forex chart, you can draw. Using the charting service that you use, you can plot these three lines, which are the 38.2% Fibonacci retracement level, 50% retracement level, and 61.8. What this means is there's a good probability that the currency pair will retrace here, may either get a support here, or may get a support here. These are the three most common form of support levels. Or if the currency pair, for example, is moving down, these are the three most resistance level. So as you can see here, the currency pair got a support here at the 38.2 retracement level. It started bouncing off from it for some time, and then it broke the 50% retracement also, and then found a good support at 61.8. And from there, it started moving in the upward direction. There was a big candlestick here, which confirmed that the currency pair is going to move up again. And once the currency pair started going in this direction, these are the three extension levels where it is expected to find a resistance. So this line is a high created by the run here. So that means this is a good resistance level, and the currency pair could have bounced off. Like for example, if you see here, the candle touched here, it tried to break this level, it couldn't, and then it pulled back. But I believe this big candle represents that some kind of fundamental announcement might have come, some kind of news, which would have enabled the currency pair to break this resistance line, and then after that it got a resistance at 38.2 Fibonacci level. It got a resistance here, it tried to pull back, it did a double top, and then it came back, and after that it continued here again, and finally it got a big resistance at 61.8 level. So the purpose of retracement and extensions are a bit different, but before we go that, there's one important thing I want to tell you. The most effective levels are 61.8 and 38.2. In a fast market, for example, if the currency pair moves very fast in one direction, it will get a good support or resistance at 38.2 Fibonacci level. If the currency pair takes its own time to go in a particular direction, at a pullback it will get a good support at a 61.8 resistance level or support level, depending on the direction the currency pair is going in. From my analysis of the charts, I have not seen 50% Fibonacci level to be that effective, to be as effective as 38.2 and the 61.8. Now, the purpose of the extension or the use of the extension and the retracement levels is a bit different. The retracement levels are typically used to find support and resistance depending on the direction currency pair is going, so that you can plan a trade or you can open a trade. You may not use a retracement level to exit a trade. The retracement levels are typically to know when to enter a trade. So for example, if once the currency pair hits here and this blue candle came, that means it's a good point to now open a trade. You are not going to close a trade here because, for example, if you open your trade here and you close your trade here, you're not going to gain much profit. So the retracement levels are typically to enter a trade, and they are also used to plan a stop loss. For example, if someone would have opened a trade here, for example, then they can place a stop loss 5 or 10 pips below 5 or 10 pips below either the 50% retracement level or 61.8 retracement level. For example, if you look here, there's a big support, big resistance, big support which is at that red line, and the following candle, it tried to go up but it didn't. It's a half body, half wick kind of candle, and the body of this candle didn't close above this red candle. So that means there was no clear confirmation that the that the market is about to go up again. Whereas here, this blue candle, this is bigger than the previous preceding red candles, and that means the currency pair is about to move in the original direction once again. At that time, the trade could have been opened here with the stop loss 10 pips below this, or rather 20 pips below this 61.8 Fibonacci level. So the retracement level can be used to know the point where the trade can be opened, as well as it can be used to place a stop loss. Whereas the extension level tells you when to get out of the trade, when the trade should be closed. For example, once this currency pair moves here, it gets a good resistance at a 61.8 level. A trader could have closed a trade here. If the trade could have been closed, again it would have resulted in about 80 to 85 pips. If the trader could have closed the trade here, they may have got another 25-30 pips. So overall 110 to 115 pips of profit. So these levels cannot be used to open a trade again. These are used to exit a trade. The reason you cannot use the extension levels to open a trade is because the currency is in a pullback direction. The other use of extension is you can use it to close half the trade and let the rest of the trade continue. For example, if you have got two lots open, you can close one of the lots here or here, and then let the second lot continue till the time let's say the currency pair hits the stop loss, or your profit target is achieved. Now let's look at the simple Forex Fibonacci strategy, which uses just 2 or 3 indicators, and it is very simple and very effective. I have told this to a lot of my subscribers, and they're quite happy with this particular strategy. So this is a Euro USD hourly chart. This is the direction which we are going to use to plot Fibonacci retracement and the Fibonacci extension levels. The currency pair started moving in this direction, starting from this candle. It got a good support here, and then it retraced to these Fibonacci levels. This particular red line I have drawn just to show support and resistance line, which was created by a previous low. So if you look here, the currency pair moved in this particular direction, and it got a good support at this particular line. The reason it got a good, not a support, rather resistance. The reason it got a good resistance at this particular point is because it is a very strong resistance. There was a previous resistance which was created by this low, and now this Fibonacci level is also very close to this previous support and previous resistance level. So this means this particular resistance level is very strong. So the currency pair came here, it got a good resistance. This red candle showed that it is now about to move in this direction again. So a trade could have been opened here, and once it started moving in this direction, it's time to draw the extension lines. So these are the 38.2, 50 and 61.8 resistance line. The currency pair started moving in this direction, and this could be the first point where the trader could have taken the profit, because this is the previous low created. So the trader can take partial profits here and then let the trade continue. And as soon as it hits, let's say 61.8 Fibonacci level, the rest of the profit can be taken. The important point to note is the trade should be opened only if the Fibonacci level is supported by another confirming indicator. In this case, the confirming indicator is this support and resistance line, which indicates that this is a very strong resistance area. And another confirmation was this big red candle. This big red candle, the body is much bigger than this blue candle, which means this is a strong push for the currency pair to start moving in this particular direction. The stop loss can be 10 pips above this particular 61.8 retracement level, or can be 50 pips away. And the exit, like I mentioned, should be at the double bottom. Like if you look here, this is a double bottom created, or at one of the Fibonacci extension levels. So this is a very simple strategy. The important point is to note that to open a trade only when the Fibonacci level is supported by another confirming indicator. In this case, there were two confirming indicators. One is this resistance line and this reversal candle. If one of these is present, then also it is good enough to open a trade. In our example, we have got two confirming indicators, but if only one confirming indicator is also there, that's good enough. And the other important point is to know when to take the profit. The profits can be either taken at this point, the first and the double bottom area, or at one of the Fibonacci levels, Fibonacci extension levels. Finally, there are 2-3 important points I want to tell you, which you should remember. First is the Fibonacci extension, like I mentioned, or rather retracement. Fibonacci extension and retracement cannot be used independently. Use a supporting indicator such as candlestick or other support resistance lines. The other is the Fibonacci levels. They work very well on the charts of all time frames. Like it can work very well on 5-minute chart, 15-minute chart, 30-minute, 1 hour, 2 hours, 4 hours, daily charts. But the best, they are most effective when they are used on 50 minutes and up. As you start going in the higher time frame, you will see that the Fibonacci levels are becoming more and more effective. So a Fibonacci level at daily chart is much more effective than Fibonacci at, let's say, 1 hour chart. And like I mentioned earlier, don't use Fibonacci extensions for entering a trade. And one more thing, I think by looking at this video, you might have realized that Fibonacci levels work very effectively with the candlesticks. Candlesticks can be used as a very strong confirming indicator if you are using Fibonacci to either open a trade or to exit a trade. So you must definitely know candlestick, and it works. Candlesticks not just work very well with the, let's say, Fibonacci levels. They also work very well with the support and resistance lines, as well as the moving average, for example. Now, thank you for watching this video for so long. And to thank you for your gesture, I have got a free gift for you. It won't cost you anything. I'm going to share 2 more highly effective Forex candlesticks patterns with you that work well, in fact, very well with the Fibonacci levels also. I'm also planning to share one candlestick mistake that 50% plus traders make. And I'm also planning to share one highly accurate Forex trading strategy which is based on candlesticks. All you need to do is visit my website, forexcandlestickmagic.com, and once you go there, you can get this package for free. You don't have to pay anything. Or what you can do is you can simply click here, and I'll see you on my website. So once again, thanks for watching this video, and click the link here and get this package, which includes Forex candlesticks patterns that work with Fibonacci level, details about the very prominent mistake most of the traders make, and also a highly accurate Forex trading strategy. So just visit my website and I'll see you there. Thank you.